Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
All right, welcome back today. We are excited to have the second part with Melissa Langdale today. Let's get started. So let me pivot a little bit to use your language there. I want to look at some stuff that's really affecting today, right? The biggest thing in the market right now that everybody's talking about is rate, right? There's a lot of things of is it price damage or price that is potentially slowing the market or stalling the market, or is it interest rates, right? If we can, I just want to take a look at history of what the interest rates are, compared to where we were in the past, where we are today. In the past, 54, 55 years, we've got rates that have kind of run the gamut. We've been as high as I think 18 and a half to we were down to sub 3, mid to high 2s. We're looking at, I think we were looking at the average on that is around 7.3, 7.74, something like that, since 71, I believe it was. As I'm looking at that, it's interesting. We just on fixed 30 for FHA, we just kind of capped we just shifted back up to, I think we're at 7 1/8 roughly. So when you look at it, everybody's crying that, man, the rates are outrageous. They're outrageous. How are we going to get back? But the reality is we're half point off basically from what even par is for the last 50 plus years. We're right in the middle of that. So I guess my question is, what is the Mortgage Collaborative doing with their lenders? What kind of messaging is going on to change the perception, so we can start getting people off the sidelines?
Yeah. Oh gosh, that's such a good question. This is a hard thing, right? I mean, there is kind of this chicken and the egg dance that's happening right now. Is it the rate? Is it, but it really, I think that the pulse of the challenge is really affordability. And the kind of lock-in effect that you hear about all the time, right? Are there people that are truly staying in their homes and not selling because, they really don't feel like they can afford that next home? So there is a component of that that's happening right now. But, affordability as a whole, right? You've got inventory that's low, so people aren't willing to sell. So inventory is low. Demand is still high. Right. So you've got this really high demand. You've got interest rates that are higher than they have been in the past. And what we've started to see now, applications have started to go up. So we have started to see really some positive movement really over the last couple of months in that regard. But the baseline challenge, as you're talking about around affordability and this kind of how much home can I really afford or attain, right? What's attainable for our family is a challenge as a whole, especially for first-time home buyers that may not have that high down payment, may not have the ability to kind of step in and be able to aggressively negotiate for that home that just came on the market that happens to be in their price point. So there's lots of things that I see lenders doing right now. One, they're starting to get kind of creative in how they support customers going through that process. If they have somebody with a lower down payment, or they have somebody that really is at a price point that they have to get really aggressive in that marketplace, I've seen lenders start to do closing guarantees with like cash back for sellers if something doesn't happen to close on time. So we've started to see some things like that. But there's lots of questions right now around like the NAR settlement too, and the impact that that's going to have on those particular buyers too. So we could probably go a billion directions on affordability. But yes, it is a challenge, kind of back to your initial question. Yes, it is a challenge. Lenders are starting to get creative, but I don't know that there are anybody that has like, that secret sauce that they've
Right.
just figured it out or are completely helping every customer that comes their way. I think customers are starting to get to the point though where they're more comfortable that this is our new reality for now. And my family has to move because, right? I have to relocate for a new job, or our family's growing, or we need to downsize, or, whatever the case may be. I mean, our industry as a whole is called to serve consumers at those big life moments that happen. Starting a family, kind of downsizing, as I mentioned, relocating for all of those are points in times where customers really need us. And those things will continue to happen regardless of the rate.
Right.
It's just kind of helping customers to be able to navigate what really is available to them at the time that they're ready to buy.
Well, and when we're talking about the affordability side of it, there's a lot of things like you talk about that come into play there. And one of the things I've been looking at lately is, especially with the time that people are staying in their homes. It used to be only a little over 7 years. I mean, we're up to people are holding their houses for 13 years now. As that lag really catches up, that in itself creates an entirely different supply situation. And when the demand is continuing to ramp up, that obviously directly affects affordability. One of the things, we're based out of South Florida. One of the things that we've seen a lot, especially because of the demand after storms and everything that's happened here over the last 3 or 4 years, especially with COVID and just the whole process, right? For the last 3 years, 4 years that everybody's seen. But from a timing perspective, one of the things on a lending side that we're seeing a lot of people ask on is rate locks. Are you guys seeing, typically, you've got a shorter term for rate lock. Definitely understand why things are moving and shifting, and the lenders have to hedge their bets on where that's at. I've seen in the last probably 4 months or so, a few people there's one lender here in the market that's actually got a 12-month rate lock. I thought that was an interesting process, that it couldn't go up, but it could go down. Are you seeing that as a tool that more lenders are coming out with to try to provide that for a customer?
The long-term rate lock it's been around for a really long time.
Right.
Because I used to do a ton of new construction and had some fantastic partnerships with builders in North Carolina, but so we use that all the time. I think so it's interesting to see lenders start to look at opportunities like that, where they're looking at whether it be a rate buy down or kind of lock solutions, like you mentioned, to help people to feel comfortable about where rates are today. So those are all like little things that lenders are looking at: long-term rate locks, rate buy downs. Are there opportunities for them to partner with companies on down payment assistance options? All of those things that can help customers to be able to feel more confident and comfortable in navigating the process.
So one of the biggest things that I'm seeing, I shouldn't say that I'm seeing that, but that people are talking about, and I've got my own opinions and beliefs on some of it, but a lot of people saying the 2%, 3%, and 4% mortgage rate is just gone. Me personally, I think there's a few things that, if they happened, could potentially push us back that way. Especially when you're talking about unemployment rate, if that climbs, I think there's a few levers that if they're pulled, so to speak, that could definitely send us back that way. But what is your belief? I mean, and as the collaborative, are you guys, I'm sure you're talking about, but do you see 5s and 6s at all? Do you see it in the near future? What's your, I'm not asking you to wave your magic wand. We understand you don't have the crystal ball sitting there, but as you guys do what you do, what do you see in that term?
So I think there's a couple of things. Number one, like you said, I don't have a crystal ball. There's no like magic knowledge that I happen to, have that nobody else in the industry has. I think
We won't hold you accountable for what you say right now. So
yeah. Somebody will.
Yeah,
There'll be a video somewhere where they're like, Melissa said rates are going to be X in the next 12 months. But no, I don't. I totally don't have a magic crystal ball. But what I can say is I do feel like there will be an opportunity for rates to go down. When that will be, nobody really knows. I think it is going to be longer, obviously, than a lot of people thought it was going to be. I think a lot of, this same sentiment or late last year, the sentiment was really kind of early spring that we'd start to see some relief. Obviously, we're still in the midst of things right now, and I don't know that we'll really have a Fed rate cut until late this year, which means spring market next year will start to probably have a benefit for a lot of lenders. So that we all know it's coming. The reason my tone is probably what it is because the number of customers that still have rates underneath 6% is astronomical, right? And so even if rates do have some relief to them, the opportunity to kind of refinance the marketplace is still going to be a lot smaller than it was in the past. And so I do think we're going to see a little bit of volume uptick when that happens, probably people getting off the fence and saying, okay, this is my moment to try to buy. But when that happens, as the demand increases, what happens to prices, right? So prices are going to continue to go up. You're going to still see that same affordability and attainability challenge that we were talking about. So, I don't know that we're necessarily going to solve the affordability challenge with lowering rates, but I do think it'll spur some momentum in the marketplace. It might help purchases, increase just a little bit. And open up the door for some refinance market. But we're not going to see like a COVID hit, right? Where we had like half the market refinance in a very short amount of time.
Well, and that's always interesting. When I speak in different places, that's constantly what I'm reminding people, especially from an affordability standpoint, and the supply and demand aspect of that. I try to remind people, listen, when you're talking about some 40% of the population has has a note with a 4 or less in front of it, and you start looking at the ones that continue to ride that to the bottom and got with sub 3s, you get to where their mortgage is worth more than their home is, and has a bigger value than their home. So, there's definitely a large group that's not going to jump on that bandwagon just because it jumps to a 5, right? They're not going to be wanting to enter the marketplace again. But
this is what it is, right? Like we can't wave a magic wand tomorrow and say, okay, well, we want 2% rates now. Let's see what we can do to manipulate the market to get us back to that point, right? Like there is, there's something to be said about kind of embracing the reality that's in front of us today and helping consumers across the country, investors across the country, even to be able to navigate the market that's in front of us. And that's where, having the right kind of professionals around you can help with that.
So another question that I get a lot that I thought I'd ask and see what your thoughts are. What's the biggest driving factor that you see, and maybe that you're hearing from your lending cooperatives and things like that? But in buying homes, do you see, let's say if we're looking at the current rate, is it home price or interest rate that's the biggest driving factor in that today, that your lenders are hearing back?
I actually think it's neither. I think it's monthly payment and down payment.
Okay.
How much cash do I need out of my pocket, and how much is my monthly payment going to be from a consumer perspective, right?
Sure.
I mean, those are the two big drivers for them. Can I afford this? Is this going to be comfortable for my family? And the affordability goes back down to monthly payment and how much cash is coming out of their pocket.
Which it's interesting because just like you talked about, there's a lot of things that are changing the supply side of that equation, that's making it harder and harder to reach an affordability. I mean, just when you look at the energy market, a lot of the things I talk about and try to teach people is, if you look at the amount of times that a 2x4 that's going to be put into that house is touched by diesel fuel. to get it out of the woods, to get it to the mines, to get it to all the places it's got to touch that to get it to your job site. And with the cost of where the energy is at to get that, you can't get that for $1.80 anymore, $1.30 anymore. You got to pay a lot more for it. So one of those things I was looking at is with inflation being what it is, Americans relying more and more on credit card use. How concerned are we doing an irreparable harm to the Americans' ability to qualify for mortgages? And it may be that we don't even have a chance or a choice in it, but
yeah. I think yes, consumer credit card debt is at a really high level right now. Normally that says there's stress in the economy, right? They're leveraging credit cards for different things. I do kind of question whether that debt is real or whether consumer behavior is driving that debt behavior, and reporting is just kind of showcasing more of a change in consumer behavior and people leveraging credit cards, even if they pay them off for points and those airline miles and all the things that go with it. So I don't, but I do feel it. I do hear it from a lot of lenders. I do see the reports on all of it. We are at an elevated rate than we have been in the past. So what does that mean? That means that consumers are a little bit more stressed, but if you think about what happens in the marketplace as you start to think about like recession, right? Where the market and the economy are really, really struggling. Consumer behavior, like credit cards is one of the first things that you look at as like a leading indicator into how into movement, I guess, in that market.
Right.
So if consumers are stressed, what will they not pay first? Right? Will they leverage the credit cards to not pay their car? Will they? But they oftentimes will still, like, the home is the last thing that they will hold on to and not have any. The good news is, in all of this, home ownership is still at a really high rate. I think the last time I looked, we were like 60, 65, 66% of the U.S. households actually own their own home. Equity is at an exorbitantly high level. Demand is high, right? So what happens if they get stressed? They just sell their home. They get an influx in cash. They get an equity line. There's lots of solutions for consumers that they've not had in the past. So yes, it is a leading indicator, but I don't know that it's necessarily the same leading indicator that it has been in the past for us.
If you're looking out at the lending industry as a whole, what do you see? What do you see is the biggest thing coming on the horizon for the future of lending in American home ownership?
Oh gosh, that's a really hard question. And I know we're almost up at time. I don't know that I can solve like all the world's problems in the next few minutes, but I will
pick one. Tell me what you think one spot is.
On the horizon would be, how do we rethink workflow design? How do we rethink customer experience? How do we take the kind of traditional mortgage process and create something that's simpler and more transparent and easier for consumers to understand? And so, like, from a future perspective, if I could wave my magic wand, like that's where I'd love to see improvements. But I think a lot of lenders are starting to think about that. I think a lot of technology solutions are starting to think about that as well. How do we create a better customer experience, more transparent process? We create operational efficiencies so mortgage companies can create that elasticity in their business model, so that as market, as they have to react to market changes, their business has the ability to not necessarily to navigate that process easier and not necessarily have to hire a bunch of folks to fill those spaces as they see that kind of market-driven growth opportunity.
So, and I know we are running out of time. I want to, if I can grab one more question with you real quick. I want to, you've actually mentioned it a few times from a technology perspective. Technology has always had kind of a deflationary effect on the economy, because, you're creating things and it's great for the economy. And then all of a sudden, well, wait a minute, we just lost a certain amount of jobs out of that. Right. So, but we need technology, right? That's the only way we can continue to improve and create the efficiencies. I'm noticing, I love the fact, I love finance. I was reading through your website, looking at your fund and a few different things that you guys have there. So do you think that the emergence of tech and especially AI, right? Especially AI in relation to the lending industry, like you mentioned it earlier, AI is still kind of in an infancy, but what do you see on that? How does that help your members? How does it help them stay ahead, or does it create a bigger challenge for them?
I think this is such a cool question, and I could literally talk on this all day, by the way, and I know we're almost out of time, but
so we should do another segment just on this then, right?
You probably should, frankly. Artificial intelligence, which really is AI, right? The first, what we would really consider AI platform was launched in like 1973,
Yep.
I want to say.
Yeah.
So yes, this is like a buzzword right now for our industry because there's lots of lenders and people in the real estate community that are trying to figure out use cases for how we leverage that to evolve our companies and our customer experience. So yes, that's a piece of it, but we used AI for a really long time. Think about how you type emails, right? You have that kind of that extra word that's added on. That is 100% AI. So I think, yes, there are lots of lenders that are trying to figure out how do we leverage it, but also how am I going to be regulated on this? What are the risks that my organization is going to see? Am I going to be held to disparate impact if I created a platform that really denied a borrower that shouldn't have been denied? So I think lenders are trying to figure out all of those things. And so AI has a lot of questions around it. For those of you that don't know, FHFA is leaning in really hard on this. They're actually doing a velocity tech sprint that is generative AI driven. If you're a lending professional or real estate professional and would like to be a part of change, that would be a great place. They're accepting applications, I think, through the end of the month, if I'm not mistaken. So it's a great place for people to get involved and make a difference. And they're specifically focusing on Gen AI this year.
Well, Melissa, I am again, I'm honored and I'm grateful that you took the time to spend with us and our listeners. I guess the last thing is, if we've got people from a lending space, things like that want to check out the Mortgage Collaborative, what's the best way for them to get in touch with you guys, find you?
So they can always just shoot me an email, mlangdale@mtgcoop.com. Or check out our website or connect with me on LinkedIn. Would love to chat with anyone that would be interested in learning more about what we do.
To all our listeners, that is going to be it. Melissa, thank you again. I really appreciate your time, and it was a pleasure meeting you and getting to speak with you.
Yeah, it was a pleasure meeting you as well. Thank you guys so much. Have a good one.
You too. Bye-bye.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.